Ladies and gentlemen, good day and welcome to Link Limited Q4 and FY22 earnings conference call hosted by Natvarlal and Sons. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Dalal from Natvarlal and Sons. Thank you, and over to you, sir.
Thank you, Lizanne. Good evening, everyone, and thank you for joining us on Link Limited Q4 and FY22 earnings conference call. So today with us we have the management, Mr. Deepak Jalan, who is the MD, Mr. N.K. Dujari, who is the Director of Finance, and representing the Investor Relations Advisor, Mr. Sanjeev Sancheti of Eurytis Advisors. So we will begin this call with opening remarks by the management on the business operations, key initiatives, and broad outlook, followed by a discussion on the financial performance of the company. After this, the management will open up for a forum for a Q&A session. Before we get started, I would like to point out that some statements made or discussions made today may be forward-looking in nature and must be viewed in conjunction with the risk and uncertainties we face. A detailed statement and explanation of the risk is included in the earnings presentation, which has been shared with some of you. The company does not undertake to update these forward-looking statements publicly. I would now like to invite Mr. Deepak Jalan to make his opening remarks. Over to you, Mr. Jalan.
Thank you, Sameer. Good afternoon, everyone. This is Deepak Jalan, and I thank you for taking time out of your busy schedule to join us today. A very warm welcome to all of you to Link Limited Q4 FY22 and FY22 full year earnings conference call. I hope that you and your family are doing very well. I will take you through the business and operational highlights of the quarter and the year gone by, while our CFO and Director of Finance, Mr. Dujari, will share the financial metrics. During the year, the company delivered strong top-line growth of over 38%, clocking an annual operating income of rupees 355 crores. In spite of schools and colleges remaining closed most of the year, we were able to achieve over 89% of pre-COVID level income in FY20. In fact, our operating income for Q4 FY22 at rupees 111 crores surpassed pre-COVID levels of rupees 101 crores in the same quarter FY20. With students going back to classroom learning, we are confident that the demand for company's products will see strong growth over the next few years. In the mass segment of writing instruments, and more specifically the pen segment, the company continues to have a strong presence with market share of about 8%. While the company had in the past focused largely on the lower segment of the market, it shifted its focus to the rupees 10 and above segment of the market with launch of Pentonic brand in 2019. Pentonic was quick in capturing the imagination of the user segment, being a minimalistic yet contemporary pen. Its aesthetics as well as writing smoothness has appealed to all segments of the market. One of the USPs of the product is its perceived value due to its unique design has gone a long way in establishing Pentonic as one of the strongest brands in its segment. In just 3 years, Pentonic alone today contributes over 25% of company's overall revenues. The success of Pentonic brand of pens has also helped the company improve its overall margins. The company's average GPM, which was below 22% in FY18 has steadily increased up to 25% in FY20 as the share of Pentonic continued to rise over this period. This was possible because Pentonic GPM is much higher at around 43%. While the top line growth has been strong in FY22, the company witnessed a sharp increase in input costs during the quarter, led by unprecedented rise in crude and polymer prices. While the company was able to absorb some part of the cost increase due to higher mix of Pentonic in the revenue basket, margins did get impacted and GPM fell by 18 basis points year on year and 241 basis points sequentially. Operating EBITDA margin also fell year on year and quarter on quarter due to lower GPM, significantly higher freight rates, and higher marketing and new customer acquisition costs as the company accelerated its marketing efforts on reopening of schools and colleges. While crude and polymer prices continue to be high, impacting our margins, we believe that such heightened prices are not sustainable and should stabilize in the coming quarters. This, along with our continued focus on higher margin products, should help us in improving our margins and profitability. As we continue to sail through these unprecedented times of high inflation, we know for sure that while these times will not last, it will usher in new learning and will mold us to emerge as a much stronger, resilient business. The company remains committed to its goal of delivering sustainable and profitable volume-led growth built on strong brand equity and gradual scaling up of the new pillars of growth. Link 2.0. Since the time we started, the company has seen many business cycles. It has been able to rudder through its way, surviving all the true profitability. With the 5-pronged strategy that we have embarked upon, we believe the company will not only grow at a rapid pace over the next few years, but will also be able to expand its margins with judicious business mix and economies of scale. Let me now take some time to explain the 5-pronged strategy adopted by the company. The first one, increased touch points. Realizing the potential of retail reach, in FY20, the company decided to unleash the power of the Kirana reach. While the competition in the sector continues to focus only on stationery and large format stores, the company, in consultation with Vector Consulting Group, embarked upon a massive project of penetrating the Kirana network of India to increase their points of presence for company's products. India has over 10 million non-stationary outlets like Kirana, medical stores, Pan Plus. In fact, from a mere 5,000 such outlets in FY20, the company has already reached 1 lakh such outlets by now, and it expects to expand its overall reach to more than 5 lakh touch points by FY25. The next is focus on higher margin products. With the introduction of Pentonic, a new chapter was written in India's writing instrument industry. No other pen company had dared to envision a pen at rupees 10 price point without metal clip, transfer film, or individual packaging. While the perceived value of the pen was rupees 10 or more, its bold, neat aesthetics and unconventional product build ensured that the margins of Pentonic are significantly higher than not just company's other products, but also that of products from competition's portfolio. Since its launch in FY19, the share of Pentonic range of products has grown to more than 25% in value terms, with gross margin of around 43% versus the average company level margin of 25%. The company continues to focus on growing the share of Pentonic revenue and is continuously adding more products in the Pentonic portfolio. The next lever is inroads into stationery products. The company started its foray into full range of stationery products through its exclusive tie-up with Delhi. Link is India's exclusive importer and distributor for Delhi, which is Asia's largest stationery manufacturer. Stationery products are highly complementary to company's main products and hence will help significantly in its top line growth. It is expected that Delhi business should add about rupees 100 crores to the company's turnover in 3 to 4 years' time. Next is step up the existing capacity. Company's focus on rapidly increasing its retail reach will go a long way in increased offtake of company's products, and to be able to meet up with envisaged demand, the company has embarked upon an expansion plan wherein it is putting up a new manufacturing facility in the existing location at Gujarat. This will not just rationalize logistics but will also result in economic synergies. While the basic infrastructure will be put up to double in-house capacity from the existing 10 lakh pens per day to 20 lakh pens per day, in order to conserve and use capital judiciously, the expansion will be modular, and in the first phase, the in-house capacity will be increased by 5 lakh pens per day. Last but not the least, ESG. True to our ideology of sustainable living, the company has taken significant steps, not just to give back to the society, but to also make the products and the processes more sustainable. In this direction, the company has taken the following steps. In an industry first, doing away with individual plastic wrapper packaging and substituting it with paper bulk packing of 10 or 20 pens in a paper box, and in the process saved 60 tons of plastic in FY22. The company employs more than 1,200 female employees in its manufacturing facilities. The company also employs and provides training to a small number of specially abled workforce. Company is a long-standing partner of Friends of Tribal Society and other such organizations in providing support for education and other welfare activities for the less privileged. The company continues to focus on its sustainability goals and is actively working on projects like recycling of used pens. Under the company's Refill More campaign, consumers are encouraged to change the refill more often rather than discarding and buying a new pen. These efforts will go a long way in contributing towards reducing carbon footprint on our beautiful planet. Now, I would like to hand over the call to Mr. Dujari to provide updates on financial numbers. Thank you.
Thank you, sir. Good afternoon, ladies and gentlemen. Many thanks for joining the Q4 and FY22 Link Limited earnings call. I will give a brief overview of the financial numbers for the quarter before we open for Q&A. I hope everyone must have got a chance to look at the earnings presentation, the press release and the strategy deck by now. As you are aware, from the last quarter, we have started disseminating product and trade-wise revenue data, which should help you to track the company's progress with clear lens. During Q4, company's operating revenue grew by about 18% from 94 crore to 111 crores. And in the full year, it grew by 38% from 257 crore to 355 crores. Operating EBITDA in Q4 fell by 11% to 6 crore versus 6.5 crores with an operating EBITDA margin of 5.3%. In FY21, operating EBITDA grew by 111% to 22 crores versus rupees 10 crore with an operating EBITDA margin of 6.1%. As already explained by Mr. Jalan in the opening statement, operating EBITDA margin fell mainly due to sharp all-around increase in the input prices, global freight escalation, as well as increase in marketing spend as schools and colleges reopened fully in Q4. Elevated input cost could keep the margin under pressure in the immediate future. However, such elevated polymer prices may not be sustainable, and we expect prices to correct and stabilize at levels lower than these in the ensuing quarters. The product cost increase in the range of 5 to 7% in Q4 FY22. We are glad to share that the company has been able to pass on the cost increase to the customer effective from April 22. Q4 profit before tax stood at 4 crores, down 10% year-on-year, and FY22 profit before tax stood at 11 crore as against loss of 4 crore in FY21. FY22 EPS stood at 5.47 versus 0.03 in the same period last year. Company has used its free cash flow very judiciously and in the process has been able to reduce its net debt significantly over the last 4 years from 65 crore in FY18 to around 3 crores in FY22. A reduction of over 60 crore in debt. Net debt by equity has also gone down to 0.02 times as on 31st March 22 versus 0.54 times as on 31st March 2018. Net debt by operating EBITDA has also improved substantially from 2.54 times in FY18 to 0.13 times in FY22. The Board of Directors at its meeting held yesterday has proposed a dividend of rupees 1.80 per share, resulting in a dividend payout of over 30%. The company will continue to focus on shareholder value enhancement and will maintain a steady dividend payout in future as well. The company is extremely focused in using its resources judiciously and has embarked upon a modular expansion plan in Gujarat. While the basic infrastructure is being created to double its capacity to 20 lakh pens per day, some critical equipment and machinery will be added in modular fashion in sync with the demand needs. While the total cost of the project is expected to be around 50 crore, the first phase of the expansion will increase the capacity by 5 lakh pens per day. It will cost around 35 crore and will be operational by Q4 of FY24. The expansion will be largely funded by internal accrual and a small loan of not more than 15 crores. On the back of expanded capacity, with customer demand expected to be buoyant, the company is well set to achieve a top line of over 600 crore by FY25, with a CAGR of 20%. During this period, share of Pantonic revenue is expected to grow to over 32%, while Delhi is expected to contribute about 15%. Over the last few months, input costs have been rapidly increasing. This has put a pressure on the margins. In spite of these headwinds, with our drive towards cost optimization, we improve efficiency, aided further by increase in share of high margin products, we have been able to stem its impact on our margins. With strong growth prospect, increased penetration through the Kirana network, and high focus on Pantonic, we should be able to achieve annual operating EBITDA margin of over 12% by FY25. With low cost modular expansion and judicious use of debt, we expect ROE to cross 18% by FY25. We continue to remain focused on our long-term goal of sustainable growth, profitability, and strong deleveraged balance sheet. With this, I leave the floor open for Q&A. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Varun Bang from Bryanston Investments. Please go ahead.
Am I audible?
Hi. Yeah.
Yeah. Thank you for the opportunity. Sir, what is the rationale for diversifying into stationery range when we have large opportunity in the pen segment? Because we have tried this in the past and we did not have great success in this. So what are our learnings from the past, and what do you think? Can you please elaborate?
So, Varun, you know that the pens are sold from these stationery products, stationery outlets only. So we are trying to leverage our existing, network of channel partners and distributors to distribute our stationery products to the retail outlets. So we've tied up with Delhi, which is a MNC, and they have a wide range of stationery products. And it is also a learning for us because we specialize in manufacturing of just the writing instruments, and this association of with Delhi, distributing stationery products is also a great learning for us to learn different categories in the stationery. Like we are distributing calculators, we are distributing scissors, we are distributing desk organizers, files and folders. So there are more than 1,000 different stationery SKUs. So I think this is a good learning for us, and in future, whichever category we feel has a great potential, we can start our own manufacturing.
Okay, that is helpful. And sir, how have our gross profit margins moved in Pantonic range in last 1 year?
So the gross margin, when we launched Pantonic, we launched it at 10 rupees, and so of course in FY19 the raw material prices were subdued, and we started with about 50% of our gross margin in Pantonic, while our legacy products under Link brand were having only about 20% or so gross margin. So it was a high margin product for us, and it was received well by the consumers as well as the trade. But unfortunately, in last 2 years, because of the input prices going up, the gross margin has come down from 50 to 43%, but it is still way above our legacy products. And so we believe that we will be able to maintain a gross margin of more than 40% in Pentonic range.
And what is the strategy to get back to the old margins? So, do you think we'll be taking price hike in the 10 rupee product, or will move up the move to the higher value product? What will be the strategy?
So Varun, the strategy is, of course, as you know, that typically in FMCG products, there are very strong price points like 10 rupees or 15 rupees or 20 rupees. So there is no price point at like 12 rupees or 11 rupees. And so it is not easy to really increase the dealer price very much. We can go up to only certain extent. So the strategy is to develop new products under Pentonic at 20 rupees MRP and 30 rupees MRP to maintain our overall, more than 40% gross margin.
Okay. And one question on shareholding. There has been some reduction in the promoter shareholding last couple of quarters. What has been the reason behind this, and is there more reduction expected in coming quarters? What is the...
So this is a little sensitive question, but let me answer this. One of the promoters, who is no more a promoter actually, although still he is in the promoter group. So he had some of his shares which he sold off, and he still has some shares which he will sell off, but the remaining number of shares are very little. So actually there is no dilution from the core promoters.
Thank you. The next question is from the line of Himanshu Upadhyay, an individual investor. Please go ahead.
Yeah, hi. I am Himanshu calling from O3 Capital. I think. My first question was on this Delhi. Okay, we have stated that we'll get 20% margins. Okay, so this 20% includes the distribution margins also, which will be shelving it out. And
no.
Or it is purely 20% for us.
It's a 20% for us net.
Okay. And the marketing and everything will be done by Delhi, or there also we won't have to.
No,
or we will have,
it's all done by us. But if there is any ad spend, it is shared between Delhi and Link.
And one more thing, see Mitsubishi and in the Delhi this thing, will we sell their pens also, or the pens will be? Okay.
We will not. It is very clear to them that since we are the pen manufacturer, we will not sell pens.
Okay, and Mitsubishi is also comfortable with that, because they are also...
Yes, because there are no conflicting products, and all the products are complementing each other, so there is no problem.
And one small thing, exports was nearly 100 crores, okay, or at one point of time. It had been continuously coming off, okay. And it was again a very strong margin in many of the geographies. What was the contribution of revenue from that? And is exports now secondary to us? Because in last few quarters we have not heard anything, and even in the current PPT or press release, nothing has been spoken about exports. Okay. So what are your thoughts on exports?
I'll just tell you that. See, pre-COVID levels, our exports was 80 crores, and in FY22 we closed at 76 crores, so which is almost pre-COVID level. So we have actually gained in terms of exports, despite the situation being the same all over the world, and our focus on export has actually increased. And from 100 crore to 80 crores, the reason has been that couple of markets they were closed because of tariff barriers in those countries. So that was the reason that, we lost about 20 crores of export revenue. So, countries like Iran or Egypt or Turkey or, so such markets, they were closed, But we are trying to make up the loss, by penetrating deeper into our existing markets and opening some new markets.
One last question and then I'll join back in the queue. See, in Pentonic range, we had 10 and 20 rupee products which were launched in FY20, okay? But is there something we are thinking on FY 15 rupees price point also? And what innovations are you thinking on those 10, 15, 20 rupee and where you have stated the growth is generally higher? So,
yeah. So, Himanshu, actually, we, as you rightly said, we already have a 10 rupee and 20 rupee Pentonic ball pen. And as a matter of fact, we are launching a retractable gel pen at 30 rupees in the month of June. So that is at 30 rupees. And then there is another product in pipeline which will be also a gel pen with a cap, which will be at 20 rupees. So we are looking at price points in the multiple of 10 rupees because in our industry we have seen that that 15 rupees price point does not really work so much. So this is our strategy going forward.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Hemang Kotadia from Anvil. Please go ahead.
Yeah. Hello. Good afternoon, sir.
Hi. Good afternoon.
Yeah. So the company has embarked upon increasing its POP by reaching out aggressively to non-stationary outlet like Kirana stores. So do you really think that each Kirana stores will give you enough volume to justify the cost of acquisition and subsequent distribution cost?
Right. So Hemant, Hindi में एक कहावत है बूंद बूंद से घड़ा भरता है. So the stationary outlets in India are estimated to be about 2 lakh outlets, while the Kirana stores are in excess of 1 crore outlets. And a study says that 45% of the pens are sold from non-stationary outlets. So, as you rightly said, that the the consumption or the throughput of each non-stationary outlet would be very small, and the cost of servicing may be high, which you are absolutely right. But our distributors who are already servicing stationary outlets in their territory, to serve these non-stationary outlets in the same beat or same territory is actually not much of an extra cost for them. So I think it shouldn't be any problem. Of course, while we are enrolling those outlets or reaching them for the first time, the cost of this is high, certainly. As I mentioned in my remarks, that the new customer acquisition cost is high, but subsequently servicing those outlets will not be much of a
problem. Okay. And are we alone the brand which are serving through Kiranas, or we have competitors?
Yes, we are the only company as of now because definitely the initial cost of reaching out to these outlets is really very high. So it's not possible for every other company to absorb those costs because typically the industry profitability, if you leave Pentonic aside, it's only about 25%. So so it's not possible for every company to really venture into this. But since we have this Pentonic support of Pentonic profitability, we are able to take this initiative.
So can we believe that is there any cost associated with this that accounted in last 2 years P&L because of that expansion?
Yes, of course. We've been investing, heavily in this, reach expansion. So, so of course it has, that cost has already been affected in the P&L.
Okay. So if the volumes will pick up, then we will see margin increase.
Yeah, absolutely. Yes.
Okay. And on the one small observation, what you get the data like in last 2 years due to COVID, what would be the digitalization happened in our core area basically? So PAN is basically a thing that one can physically wants basically. So how?
Yeah. So Hemant, right?
Hemant.
Yeah, Hemant. Yeah. So this digitalization thing, I have been hearing actually. I've been getting this question for last more than 20 years, frankly speaking. That what is the future of pen in while the digitalization is rapidly growing worldwide. But even during the COVID period, there were online classes because there was no choice. But actually, everyone believes, and which is also a fact, that a child development cannot be under online classes. They have to have offline classes. They have to go to the schools, attend physical, schools and colleges. And so I think pen is a necessity. So we are actually not really very concerned, at least in the medium term, about the future of pen.
Okay. And one last question. What will the new product line you are planning after 2 years or 3 years? Basically? What's the growth plan?
So 2, 3. So I'm not able to really visualize, what products are we going to launch in 2 to 3 years time. But certainly, as I mentioned to other query, that we are launching. See, even today, our market share in the writing instruments is, very small. It's less than 8%. And I believe that, any, forward-looking company should have at least 20% market share, even though it's quite a fragmented industry or category. But we believe that we still have that much room to really grow. And so we strongly believe that, we'll continue to develop, more products in writing instruments under Pentonic brand. And so that's, for the time being, our strategy.
Yeah. And on the questions related to your answer, so how we will improve our market share by going deeper into the distribution network, or how actually?
Yeah. So as I said that, we are targeting a minimum of 5 lakh outlets by FY25. So it's all by distribution, frankly speaking. And of course, we, also spend, a decent amount. We also invest a decent amount in brand awareness. So I think coupled with the brand awareness and the new product launch and distribution, we will be able to increase our market share.
And how much advertisement or branding expense we had done?
Generally, we have a benchmark of about 3% A2S.
Okay, sir. Thank you and all the best.
Thank you so much, Hemant.
Thank you. The next question is on the line of Amit Agarwal, an individual investor. Please go ahead.
Hi, good afternoon. Thanks for the opportunity. Sir, my question to you is that how are you trying to position your brand since you're trying to increase your touch points through so many Kirana stores and all. So do you think that you are trying to build a brand or company, or the product line will be for the masses? So my question is to understand that are you going to build a brand for the low segment kind of people, or what's your thought on that?
Not really. Actually, I don't know, if you have used a Pentonic, you would see that this product is positioned as it has a premium positioning. And today, as you know, that the aspirations, whether in urban or rural, are similar because of the media. So it doesn't matter a consumer buys from a stationery shop or from a kirana store in urban markets or even in rural markets. So for a 10 rupee product or a 20 rupee product, if it is sold from kirana, we don't believe that it is going to affect its positioning. Definitely, a pen like a Cross cannot be sold from a kirana store. But for a 10 rupee, 20 rupee or a 30 rupee pen, I think it shouldn't be any problem.
Okay. And so my next question is that, do you think that it's really wise to spend on new capacity while the world and especially the education sector is going digital? What are your views?
Yes. So I already answered this query. So as I said that, Amit, I'm facing this question for last 20 years, similar anxiety among people. But the industry has grown every year, even though in low single digit. So we believe that developing countries or developing nations where the population is increasing and the literacy is increasing while the buying power is low, the pen is going to be there, and for, as I said, for the child's development, writing is very important, which I think everybody believes into that. So I think pen is going to be here for really long time. So this is what is our belief. And yes.
And also, Amit, the education market in India is expected to grow at 14% per annum over the next few years. That itself is going to create a huge market for pens, no matter, and especially you've seen the moment the schools have started opening, you've seen the pressure on the likes of, Byju's and Vedantu and all. We've seen that. So everybody wants to go back to school.
Right. Thanks for the clarification and all the best.
Thank you, Amit. Thank you.
Thank you. The next question is from the line of Himanshu Upadhyay from O3 Capital. Please go ahead.
Yeah, hi. I got dropped off.
Okay.
I was asking one question that in Pentonic range, we launched product in early CY FY20, okay? And it was 10 and 20 rupee range. But anything beyond that we can do on 15 rupees again, which is a price point or from where growth is generally higher, what you have stated in your presentation also. And even in 20 rupees. And how important is to launch new products every year or every alternate year so that growth momentum keeps on happening? Means any of your thoughts on that will be helpful.
So I already answered a query that a 15 rupees in our industry is not a very consumer friendly price point. So we rather decided to focus on 10 rupees and 20 rupees and then of course we are going to launch a 30 rupee product in June this year. So this is our strategy, and definitely we have to introduce at least one superstar product every year, but maybe even two products. So like this year we have planned two products under Pentonic, one in June and the other in Q3. So there has to be a lineup of new introductions every year or every half year.
And one thing, in this 10,000 crore market of writing instruments, which would be the largest brand, okay? Or even in your 30 years of history in this business, what do you think can be a size of a large brand, single product, single brand, okay? Let's say Pentonic ballpoint pen, 20 rupees pen, okay? So what do you think can be the size of single product, single brand?
So, at one point of time, there used to be a Renault 045, which used to be a single largest product selling in India. That was about 20 years back. And similarly, there were some products from Cello, which were, quite a single big product. And I'm glad to say that today Pentonic is, if not the largest, it must be the second largest, or actually even the largest single product in India. And it has grown rapidly, as you know that we launched it in FY19, not FY20. And within 3 years, despite the COVID interruption, it's already a 80 crore brand, and soon it's going to be a 100 crore brand. So I think it's going to grow. We are increasing capacity of Pentonic ball pen, and it's going to be the largest single pen brand, and going to remain there for, I think, a long time.
Can we say that the largest product category, or let's say Renault 045, whenever it was peak or Cello, as you stated, were able to get 5% of the overall market? So was that the type of situation when they were at peak, or you think?
Not really 5%. Not really 5%, but certainly about 2 to 3%. A single product. We're talking of the single product.
Yeah. Single product. And one more thing. In case of Pentonic, the pricing premium and the strength what we are able to get in domestic market, are we seeing the similar strength and premium in export markets, or the exports remains the traditional link products only currently?
No, certainly. So, fortunately, there was initial resistance because Pentonic is not as cheap as the other legacy products of Link. So we initially had to face some resistance from all our customers across the world, but we pushed them to buy smaller quantities initially, and today in every order the share of Pentonic is increasing, and the share of legacy products is decreasing, which is a good news for us because, as I mentioned, the margins in the legacy products are much lower. So it's really, fortunate for us that Pentonic has been accepted across the world.
So all geographies where we are exporting Pentonic is being also there. Okay. Would it be right to say?
Yes, absolutely.
Okay. Thank you from my side, and best of luck for the future.
Thank you, Himanshu.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Samir Dalal. Please go ahead.
Yeah, hi. So actually, I had a question regarding your pen business. You're expanding your capacity. What is the current utilization rate of your existing capacities?
So, Samir, we have about, 40 to 50% of our production is in-house, and the remaining is outsourced. So almost 50-50, you can say. So
Okay,
we are so we have some flexibility. So we are currently able to utilize almost 100% of our in-house capacity.
Okay, and so going forward, this 5 lakh that you will be adding, by when will that get commissioned, you said?
That was by Q4 of 24.
So 2 years down the line.
Yeah, right. Yes.
Okay, so for the immediate growth, whatever will have to come from outsourcing. Am I correct?
So yes, right, absolutely. So we are increasing our outsourced capacity.
Now my question is, what are the margins like on your outsourced pens versus the ones you manufacture in-house? Because if your plan is to go up to the 20 lakh pens and you're producing 50% outside, why not do it right away and shift some of the production in-house? Why continue to outsource if the margins are better there?
As I mentioned that we are increasing our in-house capacity. So, there is a lead time of about 2 years, as you know, building the plant and then getting the machineries. So, soon over this COVID situation, was over, we initiated this, step of increasing our in-house capacity. But I also believe that it's good to have a mix of both outsourced and in-house capacity. And the margins, so maybe we are sharing, or let's say on outsourced capacity, our margins are lesser by 2 to 3%. So, which in a way, I think is good that we have more flexibility, we have lesser capex. So this is what is our belief.
Okay. I have one more question regarding your working capital. Now that you're going to start working with these Kirana stores and, increasing your reach, how would that affect the working capital cycle of the company, if at all?
So actually, there is no effect on our working capital cycle because, when we sell to our channel partners.
Rather, I said put it this way, there will be a positive effect because the inventory will be churned out more
faster. And on the other end, our payment terms from our channel partners is, it's like a cash down. So within 2-3 days, we get our payment.
Okay, so even the increase to all these you will not need to extend any sort of credit to anybody?
No.
Okay. If any other questions in the queue, we can take them. Otherwise, I think we can end the call.
Sir, we have one more question.
Sure, please let him go ahead.
Thank you. The next question is from the line of Saurabh Bhutra from IIFL. Please go ahead.
Hello. Good evening, sir.
Hi, good evening. Yes.
All the question has been asked. So just my question is on the one part only. I am seeing your return on capital employed. Return on capital employed from last 5 quarters is still nowhere to 20%. Can you throw the color on this?
You're right. Return on capital is low right at the moment, but the best time was FY20 when we had the full Pentonic benefit in FY20. So going forward, I think during the COVID times we had this issue, low returns. Now going forward, we should have a positive effect on the return on capital. And when we are when we are targeting ROE of 18% by FY25, so I think return on capital will be always also close to that 20% range.
Okay.
By FY25.
And second and last question is what is the debtor days?
Debtor days right now is around 35 approximately.
Okay.
In the domestic general trade business, we have around 3 to 4 days of debtors. But in the export business, we have around 35 to 40 days of debtors. And in the modern trade, we have around 90 days. So on an average, it works out to around 30-35 days. And in export in certain markets, we have little higher also.
But the average is about 30-35.
But the positive side is coming from the general trade, and the higher debtor turnover is actually from the modern trade and export business. Are you with us?
Hello?
Sorry to interrupt, sir. The line for the current participant has dropped off. We'll move on to the next question. That is from the line of Varun Bank from Whitestone. Please go ahead.
Sir, like we have seen in case of
Sorry
Renault,
to interrupt, Varun. There's a lot of disturbance from your line, sir.
am I audible now?
Yes, sir, but there's a lot of background disturbance.
I'll just try to ask my question. So like we have seen in case of Renault, it was a hit product, but then the product and the design lost its momentum. What do you think went wrong here? And now that Pentonic will be 100 crores brand, how difficult it will be for us to, sustain leadership here? Some new brand, some new design can disrupt the market again. Does that bother you?
We have observed that if a product, a well-designed product, has a very long life cycle, even 20 years, 30 years. In case of a brand from France, which is BIC, B-I-C, that big crystal pen or a big stick pen, though they are selling for last more than 40 years. So if it is a minimalistic design and, contemporarily designed, the life cycle is really long. And Pentonic ball pen has been designed in such a way that, it has a very long life cycle. Nevertheless, as I mentioned, that we continue to develop new products under Pentonic. So if there is some slackness in our existing product, our own product can replace, the product. But for now, we are actually in the mode of increasing capacity of our Pentonic ball pen. So I think we still have a long way to go. Because it's just a 3-year-old brand, I think for at least for 10-15 years, we should not have any concern.
All right, sir. That answers my question. All the best for Link 2.0.
Thank you, Varun. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for the closing comments.
Thank you, Samir, and thank you all the participants for taking out time in the evening and joining the call. If you have any more questions, please do reach out to Mr. Dujari, who will be available to answer your queries. All the best and have a great evening. Thanks a lot for joining the call once again. Thank you.
Thank you. Ladies and gentlemen, on behalf of Natwarlal and Sons, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.